Hey guys, back with another daily update video. This is just an update to my last video from last night, like I said, and checking my account, it looks like I did not get assigned my 53 strike put on AMD. So AMD must have closed a few pennies above $53, which is what I thought because when I was watching it live, I saw it at about 53.02 at 5:30 p.m. So just to recap my week from this past week, I made $215 total in premiums by selling one AMD put at 53, another put at 52, and a third put at 51. So I made $215 in premium, which came out to be about a 1.37% return on my risk for that week. And then I also still own 200 shares of AMD at a cost basis of $52.95 per share. So I think what I'm going to do next week, because AMD doesn't really have a lot of room to grow, in my opinion, because AMD's all-time highs were about $59 and some change. And like I said, I own the stock at roughly $53 right now. So best case scenario, unless I think we're going to hit all-time highs or hit new all-time highs, I have about probably $2 or $3 of max profit per share, because I think AMD can run back up to, let's say, $54 or $55. Because if you look past in the past weeks, the highest it's ever gotten is 58. Here's a peak at 57. Really likes the 55, 56 peak. So I think if we again break above this Fibonacci level, that's about $54 and a half, then I can probably sell off my shares at 54, 55, get a nice, $1 to $2 profit per share. Times 200 shares will be about $200 to $400 in profit. And I'm hoping AMD will break out this coming week, and then I can just get that profit and then have more money to invest in my other option trades for this week. Because right now, since I bought 200 shares of AMD at a cost basis of $52.95, I have $10,590 of my portfolio right now tied up in AMD. So that's roughly the equivalent of 2 options contracts on AMD at like the $50, $51 strikes. So by having this money tied up in AMD, not that it's a bad thing if the stock price goes up and I just can sell off for stock appreciation, I'm limiting myself to 2 less options trades on AMD this week. If I hold, the longer I hold it, the longer I can't spend that money on other options trades. So I'm gonna have to see what AMD does come Monday. Hopefully, some good news comes up this weekend and maybe AMD just opens up at 54, 55 or something, and I can just sell it off immediately and then have that capital available probably the next trading day, because I have to wait for that cash to settle before I can use it to sell options. So that's my thought process with AMD. I kind of got a little lucky, like I said, because AMD literally ended the day pennies above my strike price. And I mean, that was my own doing. If you watch my other videos, I knew I wanted to be a little bit risky, so I knew I was making riskier trades this week. But I sold that 53 put. That was at the money, so it couldn't have gotten any more riskier than that. So I mean, I guess it could have if I sold in the money puts, but that's just not smart in my opinion. So that's what I'm looking at doing for this coming week. I'm really scared and nervous about the market because, I mean, we really just rallied hard on Friday. I mean, every stock was green. If we take a look at the sector map again, I mean, there's very little red on this board. And we weren't just a little bit green. I mean, we were 2%, 3%, almost 5% in some stocks green. So maybe we'll pull back a little bit on Monday. I mean, if we do, that's going to be good for option sellers like me, because then we can, again, lock in lower strike prices if we end up getting assigned. But that's my concern, is that, are we really going to get back to all-time highs right now? I mean, I think QQQ is at or even surpassed the all-time high. Let's just take a quick look. I mean, we're at $239 a share. Pre-pandemic, yeah, we were at $237. So on Friday, QQQ hit an all-time high. So I mean, this is made up of the NASDAQ 100 stock, so a lot of very, very tech-heavy, which has been carrying the market. But I mean, especially for QQQ, I would be hesitant personally getting into some puts, because like I said, are we just going to keep going up and just keep setting all-time highs when I feel like more and more bad news comes out about the economy every week? I've been getting asked a lot of questions, or I've seen people commenting on my videos that you know, they say, oh, I wish I had enough capital to invest in stocks like AMD or Micron, because they don't have enough money in their portfolio to sell cash secured puts. And that's not necessarily true. Yes, if you want to sell a pure cash secured put on a stock like AMD, let's say you want to sell a $50 strike put, yes, you need at least $5,000 in your account as collateral in case you get assigned the 100 shares at $50 each. If you really wanted to still play stocks that are maybe out of your price range, you can sell spreads. Now, if you're not familiar with what a spread is, basically what you're doing is you're still going to sell a put on the stock that you want. So let's take AMD for example, and let's say you're bullish on AMD, meaning you think AMD is going to go up, so you just want to collect some free premium. I put free in quotes because nothing is free, but let's say you just want to collect premium and not have any shares of AMD assigned. So what you're going to do is you're going to pick the strike price that you want to sell your put at. So let's just say, you know, you don't want to be that risky. So just to keep it as a nice round number, let's say you want to sell the $50 strike put. And for that, you would collect $35 in premium. But like I said, you would need $5,000 in your account as collateral, because if AMD does drop below $50, you would need $5,000, because $50 a share times 100 shares, you would need $5,000 in your account to buy that stock and own 100 shares of AMD at a cost basis of $50. But let's say you don't have that much money in your account. So what you can do to kind of offset that collateral is you're going to buy a put that's below that strike price. So if you buy a put at, let's say, the $47 strike price, there's now a difference of $3 between the $50 strike that you sold and the $47 strike that you bought. So now you might be asking yourself, well, why don't you do this all the time? The reason is because you are limiting your max profit. Because by selling the $50 strike put, you're collecting $35 in premium. But then to offset your losses, you have to buy the $47 put. So you're gonna have to pay $9 in premium, right? You're paying for this one because you're buying this put. You're making money off this one because you're selling this put. So really, for this spread, and these are called the vertical spreads, your max profit now is $35 minus $9. So your max profit is now $26. So if you only sold the cash secured put at 50, you would get $35 in max profit. But by offsetting your max profit and also limiting your risk, your max profit is the difference between these two premium values, so it's $26. Now, the other downside to this, and this is my personal opinion, is you are going to lose money if the stock goes against you. If the stock price stays the same, let's say AMD keeps trading sideways at $53, both of these puts are going to expire worthless, and you will get to keep your full $26 in premium, okay? So if AMD, let's just say, drops the $45, that's the worst case scenario, your max loss is going to be the difference in value between your two strike prices. So your max loss is going to be $3 a share, or $300 per contract, because $50 minus $47. And the downside, in my opinion, is that that is your pure loss, meaning you're going to lose that money, period. So this is much more like gambling to me, because you're either going to make $26 because $35 minus $9 in premium, or you're going to lose $300, which is $500 minus $470. So those odds, may not seem that great, but you can play with those numbers depending on how the premiums change and how wide you want your strikes to be. Because, for example, if you pick tighter strikes like 50 and 49, your max loss is only $100, because 50 minus 49 is $1 times 100 is $100. However, your max profit is also less because it's $35. This is the option you're going to sell, so you're going to collect $35 minus $23 because this is the option you're going to buy. So now your max profit is only $12. So you can see you're going to collect less profit, less potential profit, for less potential risk. So that's why I say everything is a risk to reward ratio. I don't like trading vertical spreads because of that reason. Your loss is truly a loss of money. The reason you do this is so that you don't have to have $5,000 in collateral to put up and get assigned those shares. With spreads, you will never get assigned shares of stock. You will simply just lose your money if the stock price goes against you. So if you really wanted to play stocks that you don't have the capital to do so, you can play them with spreads. And like I said, I personally don't like this because I don't want to just flat out lose money and have nothing to show for it. At least with selling cash secured puts, if the stock price goes against me, I still have 100 shares of that stock now that I can hold on to and sell covered calls on, or just hold on to and wait for the stock price to go back up and sell off to recoup my quote unquote losses. With vertical spreads like this, there's no way to recoup your losses other than making more money on the next trade. So I know a lot of people like to trade spreads just because they feel as though they can make many more options trades without having a lot of capital. And that's perfectly fine, to each their own. But I just don't like the thought of having to guess or pick directions of stock, because if I don't pick correctly, I'm just going to flat out lose money. So some people would be okay with, oh, I made $400 this week, but I lost $200 next week, and then I made $100 the following week, but then I lost $50 the next week, and it's kind of this roller coaster ride of up and down, up and down, up and down, and hopefully at the end of the month or at the end of the year, you hope you end up in the green overall. I don't like that feeling. I'd rather just make slow, consistent profit every week. I mean, even if I'm making, like I said, $100 a week, that's a 0.4% return on my risk on a portfolio of $25,000. And again, I know this is not accurate because I'm not taking into account reinvesting my extra profit every week. But just to do a quick and dirty method of calculation, if I can get 0.4% every week times every week for 52 weeks, I can collect almost 21% return on my money in a year. In my opinion, this is a much safer strategy than selling spreads. But like I said, I'm able to do that because I have the capital to sell cash secured puts on the stocks that I'd like to. 21% a year is nothing to kind of shake your finger at, because no bank account or savings account or checking account is going to give you that much interest in a year. And if you look historically at the stock market, I mean, even if you look and average out over the past decades, the market will return 7, 8, 10, maybe 12% a year. It doesn't come close to averaging a 20% return on your money. And if you really think about it, by selling these cash secured puts, whether you want to do them weekly or bi-weekly or monthly, you don't have to spend a lot of money. Just pick some stocks that you like. All you have to do is spend, maybe 30 minutes the night before just researching the stock and making sure that that's what you want to make a play on, making sure there's no earnings coming up or some bad news that's coming out. And you just spend 5 minutes, make the trade in the morning, the day you want to make the trade, and then just go about your life, right? You don't have to monitor the market all day, every day, and trying to swing trade or day trade. So in my opinion, it's a relatively easy, and I say easy meaning not time consuming way, to make just slow residual profits as a side hustle. The last thing I wanted to show you was, in case you were interested in selling a put credit spread like I just showed you, if you're using the Robinhood platform, you can confirm and make sure that you're doing it properly. So what you're going to do is, let's say you were interested in making the trade that I just showed you. So the first thing you're going to do, like I said, you're going to sell a put and you're going to pick your strike price. So we selected a $50 strike in terms of the put that we're going to sell. Okay, so instead of clicking the number, click on the plus sign here, and what's going to happen is it's going to get added to your kind of checkout window here, okay? So right now, it's correctly thinking that you want to sell a put because it's short put. So short is kind of a synonym for sell. So you're going to sell this put. So if you were just wanting to sell a cash secured put, this is all you would do. It says you're going to get a total credit of 35 cents, which is correct because that matches this number here. And you would just hit continue and you would place the trade. This is what I do every week in terms of selling cash secured puts. But if you want to sell a put credit spread like I just showed you, now what you have to do, since I said we have to sell the $50 put, and now let's say we want to select the $47 strike price, the key here is you have to remember you're going to buy this put. So we're going to switch over to buy, and we're going to keep it on put because this is a put credit spread, and we're bullish on the stock, meaning we think the price is going to stay above $50. So we want our options to both expire worthless and just to collect the difference of premiums. So then you're going to go to your bottom put that you're going to buy now, and the same thing, you're going to hit the plus sign. So now you see both puts are added here, and you can see Robinhood automatically does the math for you because Robinhood knows that you're going to collect 35 cents per share by selling the 50 strike put, and now you're going to buy the $47 put, so you're going to have to pay 9 cents. So it does the math and it tells you that your total credit, meaning you're going to be collecting 26 cents per share or $26 for this contract because it's 35 minus 9. 35 because this is what you're going to get paid for it, 9 because this is what you're going to pay for it. So it's 35 minus 9 equals 26. And you can see Robinhood correctly identified that this is a put credit spread. The other key thing you have to keep in mind is that the expiration dates have to be the same. You want to keep them on the same expiry. There are strategies where you can change the expiration date between the options that you're buying and selling, but those are a little bit more complicated strategies, and if you'd like, I can get into them in further videos, but I like to keep things simple and basic. So you always want to make sure if you're trading on Robinhood, make sure it says put credit spread, and then make sure your total credit here, is correct. It equals what you calculated in your head. So what Robinhood will do now is it will only make this trade once both options get filled at the same time. Meaning it's not going to let you hanging and fill your 50 strike put, but then say, oh, you know what, I can't fill your 47, so you're just going to be stuck with this. It won't do that to you. It's only going to get filled if both get filled at the same time. So it is possible that depending on the stock you choose, if it's not very liquid, let's say this option is very popular, so it's very easy for this one to get filled. But if your other option is not very popular and that one's having a hard time getting filled, then the whole transaction will not get filled. So you have to make sure that both of your options are liquid enough so that you get filled. Because what you may be thinking is maybe you'll say, okay, you know what? I'm going to sell the $50 put, but then I'm going to buy the lowest put I can for $1, right? And you're going to say, I only want to do this because you know what? I'm only going to lose $1 in premium because 35 minus 1. But I also won't get assigned shares unless AMD falls really hard. It's probably not going to work because if we open up this options chain, see there's zero volume and only 31 open interest. So this is not a very liquid or very popular option. So if this option can't get filled, then your whole transaction is not going to get filled. If we look at this option, see it's got a volume of 6,310 and an open interest of over 3,000. So this one is going to get filled easily. But you also have to keep that in mind if, let's say you put a trade on and you can't figure out why it's not getting filled, it might be because one or both of your options are not very liquid. So I know this was a little complicated compared to my previous videos and how I trade. Of course, none of this is financial advice. I'm just purely providing you this information for education and entertainment. So let me know if that was helpful. I don't know if you guys want me to talk more about vertical spreads and iron condors and such, just because I don't trade them. But if you are interested in learning more about them, I'm happy to make more videos about it. I know this was maybe a little bit hard to follow just because I don't have a lot of diagrams, but if you want me to make those videos, I certainly can. Just leave a comment below, and if you have any other questions or comments, also leave them below, and happy trading.